Welcome back, everybody, to another episode of the Wealth Building for Dummies podcast. My name is Kyle Demian. I'm here with Renji Matthew, and today we're going to be talking about why real estate is one of the best investments you could make. We're going to break down the numbers and kind of just compare side by side whether you were to invest into real estate versus investing into the stock market. And we'll look at some different options and kind of just break down the numbers and show you what you could expect potentially with owning real estate and going that route, right? And as always, we're big on talking about, how to build wealth and getting into passive income and assets that produce passive cash flow. Because remember, the financial freedom formula is that when your passive income, your passive cash flow is greater than your expenses, you're financially free, right? And what does real estate have that we love? It has cash flow, right? Cash flow is king, as Grant Cardone would say. So Renji, start us off. Anything that you want to start us off with, talking about real estate versus being in the market?
Before we actually start off, I want to say we are just two dummies. Don't take our word for anything. Go do your own research and talk to your tax advisor or your lawyers and different investor strategic partners and stuff like that before you do anything. But we're just talking about our experiences, and like I said, we're just two dummies trying to show you guys what we learned and what can benefit you if you go that route also. Okay, so I guess what we can do is compare what it looks like if you put 100,000, let's say, into real estate or 100,000 into stock market. And when I say that, I don't mean just when I say into real estate, I don't mean just on a primary home. I'm talking about like as real estate investing into a rental property or investment property. So Kyle, you can go ahead and share your screen and do the
Pull up and share the
calculations.
screen.
Yeah,
let's do it. So yeah, we were kind of chatting about this before the show, and we found this pretty cool calculator website, right? So as you can see here, this is going to compare real estate versus stock market returns, and it's just an investment/ROI calculator. So if we scroll down, this is going to help us just break down the numbers of what it looks like investing into real estate versus, keeping your money or putting it into the market. So let's see here. As we're going through purchase price, so this is the first option is going to talk about investing into real estate, right? And it's going to say, what's the purchase price that you want to use? And I think let's keep the numbers rounded even. Let's use $100,000. That's going to be like our down payment. That's what's coming out of pocket. And for an investment property, you usually have to put about 20% down. So with $100,000, you could get a $500,000 property, right? That's 20%. Any legal and regulatory fees, it looks like this was filled in. So let's just keep that as is. Let's just assume there's no renovation, repairs, no other fees. A land transfer tax, that already filled in $10,000. We'll just keep that as is. Annual property growth rate, this is assuming for inflation, and that assumes 3%. And I think that's a fair number to use, so we'll keep that at 3. Mortgage insurance, like it says here, is typically only required if you have less than 20% down. We're using 20% down, so we won't have that. Our mortgage amount is going to be about $400,000. And then here's an interesting thing, interest rate. Let's use interest rates as of today, and we'll just estimate about a 7% rate. You think that's fair, Renji? Oh, I can't hear you. Did you mute yourself? Oh, you did. Yeah.
sorry. I was going to
That's
say,
okay.
yeah, that's more than fair because on investment properties, they're a lot higher than personal mortgages too. So that's more than fair.
For sure. Yeah. And actually for 500,000, I mean, especially if you're looking for an investment property, I mean, this is probably, depending on some areas, probably a duplex, maybe even a quadplex, right? So 7% and a 30-year mortgage, that would put your monthly mortgage payment at about $2,600. And let's just use the example. Maybe let's say that this is a duplex. And let's say hypothetically we could rent out both sides for $1,800 a month. So maybe about $3,600 a month would be our cash flow or our rental income. And this would leave us about $1,000 a month of cash flow after the mortgage. Maybe let's round this up to 4,000. Let's say we can rent out both sides for $2,000 a month. And, this is what obviously investors are looking at and kind of breaking down the numbers to see if it's going to make sense, right? So they want something that's going to cash flow. And I would say if you could cash flow 1,400 before taxes and insurance, that's probably a pretty good deal for a duplex. This does factor in monthly property taxes, some maintenance fees, general repair allocations, and an occupancy rate of 100%. We'll leave that as is for now. And cool. This will also, if we want to, we can calculate and factor in for utilities. Let's just say that the landlord puts the utilities onto the tenant. And then here we can look at your option 2, putting your money into stocks. And let's just say for stocks that, so it's using 113,000, because if you look up here, technically you're putting 100,000 down, and then you've got these other fees of 3,000 and 10,000 as well. So this is truly comparing $113,000 going towards, a real estate property, and the other 113,000 going towards stocks, right? Or putting your money in the market. So we'll do that. Purchase fee, sure, that was already filled in. Annualized return, we've talked about it before. I guess this is a 50-year return. I like to use 7.30%, because that's the return over the last 30 years, which would go back to 1994. And then this also can have a management expense ratio of about 0.08%, which is based on various fees of S&P 500 ETFs. So this is if you were to manage your accounts by itself. We've talked before, financial advisors typically charge about 1%. Let's not say you're putting this money with a financial advisor. Let's just say you're managing it yourself and just putting it into an ETF for the S&P 500. Cool.
And I also
So with
want to
that,
add,
let's run the numbers. Go ahead, Renji.
before you run the actual numbers, some of those numbers in the top where that was already automatically filled in, those could vary depending on your states too. I just wondered for everyone that's listening in, um, those numbers are just put in already in there, but they could vary depending on your state, because some of these are not going to be the same. I think the land trust thing, that's not in all the states either. So there's
Yeah,
some of the taxes, property taxes, some of the ways things are done are different in different states too. So this is a general example. So just wanted to clarify that before we
for
went
sure.
further. Go ahead,
Absolutely.
Kyle.
No, that's good. That's good. And yeah, with that, if we come down here and click to calculate and run the comparison, you can see here, it breaks it down. You've got your initial investment, you've got any startup fees and expenses, and then it starts to show you your net income or fees over, remember, this is a 10-year comparison, 10-year equity comparison. So you can see over time with real estate, it's estimated your 100,000 would appreciate and be worth about $470,000. Whereas if you were to put your money in the stock market, it would only be worth about $226,000. You can see the difference is about $244,000. And what I like is this also shows like your annualized ROI, or your return on investment. So this is estimating with what the numbers we put in up above were. Your annualized return on investment for real estate would be about 16% a year, whereas your stocks were about 7.2. And actually, that sounds about right, because we used a 7.3% growth rate, and there was a little bit of fees in there just from having the ETFs, right? So Renji, what are some of your initial thoughts, or anything else that you want to kind of cover for us while we're looking at the comparison side by side here?
I mean, the biggest thing you see the biggest difference in rate of return, and even that, something that a lot of real estate investors look at on properties. They want to see, what a rate of return would be with all the expenses going in and occupancy, which in this example, it was 100% occupancy. And it's not always the case. If it is 100% occupancy, awesome.
Even
That means you
better,
don't have to
yeah.
worry about finding any. But so a lot of times they're looking at those numbers, and 16% is not a bad number for real estate, especially with all the expenses and different things like that. But I think one of the reasons we consider it as one of the best investments is not only the income that comes in, but it's also the tax benefits. right? The tax benefits compared to most other businesses is a huge difference. And we can talk about that a little bit further. But one thing I wanted to point out right now, during COVID and even after COVID, a lot of these numbers have changed a lot because you could still get good rate of return on properties if you're finding them and you're getting it from discount. A lot of times, what real estate investors do is they find people that are delayed on their payments or going into pre-foreclosure or something like that, and they get it for a much deeper discount than what the value of the actual house is. So if they're getting deals like that where you're getting it for such a discount where your rate of return is going to be amazing because you're getting it at a discount, because everything's overpriced right now, right? With
Yeah.
inflation and the way the property values have gone up like crazy because of COVID and all that stuff, uh, you're not able to, not all the time, but several times, you're not able to get the full uh, amount on the rent. So typically, this is what I used to do, and this is something that I learned when I got into real estate. What my mentor used to say was try to see if you can get at least 1% on rent of the value of the house. So if the value of the house is 100,000, you want to see if you can get at least 1% on rent. So at least 1,000 or more. If you can get more than that, even better, right? So that was always what we looked at. But with COVID, that wasn't always the case because a lot of people didn't couldn't afford rent. First off, because a lot of people wouldn't have, they lost their jobs because of COVID, different things like that. And if the value of the house has gone up because during COVID, property values went up, skyrocketed. I think on average it was between 50 and 70% more than what the value was before COVID. So if $100,000 house went up to 150, if you go according to the 1% rule, that's 1,500 in rent. But if people lose their jobs or they can't afford their rent, now if you keep that property on the market for so long where you're not finding anyone that can pay the rent, right? So eventually you go to where, okay, let's lower the rent. Or you take someone, let's say they're paying 1,000 or less. Now the property value is higher at 150. 1% is 1,500. So you're not technically getting the 1%, right? So there's different things, good and bad things on that. But again, this is just a general example, but just wanted to throw some things out there that would make people think that are watching, just so they know the differences in the market and different things like that. But yeah, one of the biggest benefits, and Kyle, you can go into this if you want, and we could start talking about this too, some of the tax benefits on the real estate side compared to other businesses. Um,
Yeah, that
yeah,
was one of the things that we didn't even touch on. Like that was just looking at appreciation and um sorry, I was trying to adjust the lights. That was just looking at appreciation and income, right? And what your total ROI would be. It doesn't address taxes at all, which could be difficult, based on just a calculator because there's so many other circumstances that can play into, what kind of tax benefits you could have. But going back to, Rich Dad, Poor Dad and the cash flow quadrant, which I think is always relevant when talking about finances, right? Once you move over to the right side of the quadrant and you become a business owner and investor, you start to have access to a lot more tax codes and a lot more options to help you reduce your taxes legally. Now, obviously, an investor is still somebody that's investing in the market, but you take that to the next level when you start getting into real estate, right? You get depreciation where you can start to write off, your house as what is it exactly? Like you can write off
yeah. So
a portion of your house because over time things are going to depreciate, need replaced,
yeah,
need fixed, right?
yeah,
Okay, I would
it's
say, did I miss
27.
anything there?
It's 27.5% over several years or whatever that
Yeah.
you can write off. Yep.
So you get to write off depreciation while your house appreciates, right? Which to the new investor or to somebody just listening for the first time, how can you get both? You do. That's why we talk about real estate as having such great tax benefits, right? And then not only that, like there's different laws and different ways that you can reduce your tax liability through being in real estate. Renji, anything you want to add on to that?
Yeah. And when we say value of the property, there's also whatever's inside the property. And in some states, you can also count the land value too. It's basically any expense. We've talked about in the past. As a business owner, you're like Kyle mentioned earlier. There's so many more tax codes that can benefit you that you can use to write off more on your taxes, right? Because on the stock side, let's go back to the same example we used in the beginning. If you put that same money into the stock market and let's say you might have made 10,000, let's say, right? Just to keep math simple. Let's say that's 10% on your return on your income. But on the real estate side, let's say you only made 5,000. When you look at pure return on investment, you only made 5%. But on the stock market side, you don't have all the tax benefits that you do on the real estate side, even if you're a business owner on both sides. Because on the stock market side, I think there's short term and long term capital gains, right? Short term, I think it's like 37%. Long term, it's between 0 to 20%. It also, I think, depends on income brackets and wherever you're at, right? So on the real estate side, though, you can depreciate the value of the house, like we said, whatever's inside the property, any expenses that was put for repairing the property taxes. There's mortgage interest, whatever you paid on the interest on the mortgage. I said repairs, maintenance. Yeah, but any expense you have for that business, you could write off. And it's the same thing on the stock market side too. If you're running the stock market as a business, you could write off any expenses you have, but you're not going to have enough expenses to write off as much as the value of a property, right? So
Yeah,
that's where you get to keep more of your money, or get back money in taxes because or because of the different tax benefits on the real estate side.
for sure. And like we said at the beginning of the show, by all means, we're not tax professionals. Seek guidance and help with real estate from your tax professional. But like these are just some of the areas that are out there. And you always want to make sure you have a tax professional that's helping you take advantage of all these different tax benefits, right?
Yep.
Because like the numbers show, that was a 16%, annual rate of return. But there are some ways that people that own real estate, in lots of real estate, can actually pay, $0 in taxes in any given year. And that's
Yep.
what's possible when you're investing into these type of asset classes that just don't come from stocks. Don't come
Hmm.
from just owning something that's in the market, right? And so with that, I think Renji, that's probably a good way to wrap up the show if you don't have anything else to add. But yeah, do you want to leave us with something else before we wrap up for today?
Yeah, only other thing I was gonna say, and it's generalized business. Like, so guys, if you are looking to start a business or have any ideas that you want to try out, there's so many more benefits on that side just to have the tax benefits. Like we mentioned before many times, there's about 7,000 pages in the tax code, and with all the rules and regulations, there's more than 77,000 pages, and only 30 pages is about how to pay taxes. 30 pages. The rest are how not to pay taxes or defer taxes. So those are mostly written for business owners. So even if you don't get into real estate, you start some type of side hustle or something like that. There's so many more tax benefits where you can keep more of your money instead of paying it all to the government, where you can't control what the government does with your money, right? But at least this way, if you know how to look through the tax code, and you don't have to, just get a good tax advisor that prepares them the right way, right? And we did an episode on this previously too. There's different types of tax advisors too. Some are just bookkeepers. Most of them are just bookkeepers. You got to find one that is a strategist and they do business themselves, so they know the loopholes that they can help you do too. Again, they're not loopholes; they are in the tax code. Um, but yeah, that's what I want to end with. Just get into something.
Yeah, for sure. And like we talked about from the book that we're reading right now for our book club, which we'll be talking about on tomorrow's show, the tax law was written to incentivize actions that bring the economy more jobs or bring affordable housing to the US economy, right? And real estate is what brings affordable housing. to our citizens. And so, yeah, the quicker you can get into real estate and or business, the more that you can start saving on taxes. The tax law was written for entrepreneurs, business owners, and investors to help incentivize actions that the government needs and wants us to put into the economy, right? So don't be scared. Don't be scared. Don't be scared. I should have kept it. Don't be scared of the tax law. The tax law was written to incentivize actions and to help you, promote you to make more money. And that's what taxes can do. You can decrease your tax liability while increasing your income when you have the right tax professional on your side. So thank you guys for tuning in to another episode of the Wealth Building for Dummies podcast. Make sure to like, comment, and subscribe. Drop your thoughts below, drop your questions below, and maybe we'll do a show just on that. And we'll see you guys on the next episode. Take care.